Hello, everyone, and welcome to this explainer. I am absolutely thrilled to be your guide today as we unpack a fascinating and honestly a highly anticipated document from the Reserve Bank of India. We are going to be looking really closely at the newly released 2026 directions on commercial bank dividends and profit remittances. Now, if you follow the banking sector, you know that regulatory updates can often feel like this dense maze of financial jargon. But today, we're going to completely demystify it together. We're going to break down exactly what these new rules mean for the entire financial landscape. It's the million-dollar question. Well, actually, more like the multi-billion rupee question, right? When a bank has a truly fantastic year, how do they decide how much of that profit can actually be handed back to shareholders as a dividend or remitted back to a foreign head office? You see, a bank can't just go and write a blank check out of its net profit. There is a massive, absolutely crucial systemic risk if a bank pays out too much cash when it might actually be undercapitalized just beneath the surface. So to protect the entire financial ecosystem, the central bank steps in. And the rules of that high-stakes game are exactly what we're unpacking today. Okay, let's dive into this. Here is our 6-part playbook for today. 1. The new RBI playbook. 2. Who must follow the rules. 3. Passing the eligibility test. 4. Calculating the maximum dividend. 5. Remitting profits abroad. And finally, 6. Compliance and consequences. Section 1. The new RBI playbook. Right, so here is the official source document we are analyzing today. You can think of these rules, which, by the way, come into full effect for the 2026 to 2027 financial year, as a strict referee for the banking system. The RBI's primary goal here isn't to stop investors from making a profit, it's to maintain a robust safety buffer for everyone. By legally defining the parameters around profit distribution, the RBI ensures that banks keep enough capital in their vaults to weather economic storms long before they reward their shareholders. To really grasp the whole framework, you've got to understand this one single crucial concept: adjusted profit after tax, or adjusted PAT. I want you to visualize a giant funnel. At the very top of the funnel, you pour in the bank's total net profit for the year. But before that profit can drip out the bottom as a dividend, it has to pass through a filter. And that filter? It's the bank's bad loans. Specifically, the RBI forces banks to subtract 50% of their net non-performing assets as of March 31st from their profit. Only what survives that subtraction is actually considered adjusted PAT. It's a pretty brilliant way to penalize banks with high bad loans because it directly hits their capacity to pay out dividends. Section 2. Who must follow the rules? Now, what's really interesting about this slide is how the RBI draws a very clear line between different types of financial institutions. We have the entities bound by these new directions. That's all commercial banking companies, the State Bank of India, and foreign banks operating as branches in India. But then you'll see a specific list of excluded entities: small finance banks, local area banks, payments banks, and regional rural banks. They do not fall under this specific set of 2026 directions. This ensures the heavy regulatory machinery is targeted exactly where the systemic risk is the highest. Section 3. Passing the eligibility test. Okay, so first things first. The bank's board of directors has to do some serious homework. Before proposing any payout whatsoever, the board must formally evaluate several key factors. They have to look at NPA divergence trends, meaning, are the RBI supervisory findings showing more bad loans than the bank actually initially reported? They must review the auditor's report for any modified opinions, assess their current and future capital position against regulatory needs, and then weigh all of that against their long-term growth plans. The RBI demands this strict board oversight because it places the ultimate responsibility of verifying the bank's health right at the top, before a single rupee ever leaves the vault. And beyond the board's review, there are hard operational hurdles. To even be eligible, the bank must have met its regulatory capital requirements, not just at the end of the current financial year, but the previous one too. Furthermore, they have to mathematically prove that paying the dividend won't suddenly drop their capital below those required levels. They need to have a genuinely positive adjusted PAT, and crucially, they cannot be under any explicit RBI restrictions. This acts as a rigorous safety check to prevent chronically undercapitalized or poorly managed banks from distributing cash that they desperately need to keep. Section 4. Calculating the maximum dividend. So the crucial point is the RBI's tiered system, which is based on the bank's Common Equity Tier 1, or CET1 ratio. Think of CET1 as literally the highest quality core capital a bank holds. The RBI maps this ratio into 10 buckets, from B1 to B10. If a bank is in bucket B1, meaning their capital is just barely meeting the bare minimum, they are allowed to pay exactly 0% of their adjusted PAT. But as their capital buffer grows, they climb the buckets. Scoring higher in these capital buckets literally unlocks a larger percentage of distributable profits. This goes all the way up to bucket B10, where a bank with massive capital reserves could theoretically pay out 100% of their adjusted PAT. It's an incredibly elegant incentive structure. Hold more safety capital, and you get the freedom to reward your shareholders more. However, there is an absolute ceiling. No matter how fantastic a bank's capital position is, and no matter if they sit comfortably in the highest CET1 bucket, the aggregate dividend declared cannot exceed 75% of the total profit after tax for that period. This aggregate cap ensures that at least a quarter of the net profit is always retained to fuel future growth and absorb any unexpected shocks. Let's actually look at how this funnel metaphor and bucket system works in reality, using an official illustration directly from the RBI's Annex 1. In Step 1, our hypothetical bank starts with a very healthy net profit of 17,000 crore rupees. In Step 2, we apply the funnel filter. We subtract 50% of their 6,500 crore rupees in non-performing assets. That subtraction gives us an adjusted PAT of 13,750 crore rupees. Moving to Step 3, we look at the bank's capital ratio and we see they fall into bucket B3, which limits their dividend to 30% of their adjusted PAT. Finally, in Step 4, we calculate 30% of that 13,750 crore rupees to get our final maximum eligible dividend, 4,125 crore rupees. So as you can see, the gross profit was 17,000 crore, but after the RBI safety math, the maximum payout is really just a fraction of that. Section 5. Remitting profits abroad. Let's sharply pivot the narrative now to a totally separate regulatory track, foreign branches. For them, the goal isn't paying domestic shareholders, but remitting surplus profits back to their global head offices. While they don't use the bucket system, the RBI is incredibly strict about what kind of profit can actually leave the country. Foreign branches cannot remit exceptional or extraordinary income. If their auditors issue a modified opinion that suggests the profit is overstated, well, that overstated amount is locked down. Furthermore, they absolutely cannot remit net unrealized gains on complex Level 3 financial derivatives. By detailing these specific exclusions, the RBI ensures that foreign branches are only sending hard, realized, cleanly audited cash back home rather than artificially inflated paper gains. Section 6. Compliance and consequences. And this brilliantly illustrates the tight leash the regulator keeps on the industry. Once a bank actually declares its dividend or remits its profits to a head office, the clock is ticking. They have exactly a fortnight, just 14 days, to submit a highly detailed report in a prescribed format to the RBI's Department of Supervision. Transparency has to be immediate. Because if a bank gets it wrong, the hammer drops. The directions are crystal clear on this. There are zero shortcuts here. If a bank fails to meet the strict eligibility criteria we just discussed, the RBI explicitly states that no special dispensations or exceptions will be granted. If you break the rules or distribute profit you aren't entitled to, you face the full weight of RBI enforcement. That can include immediate restrictions on any further profit distribution and severe supervisory action. It's a complete zero-tolerance policy for playing fast and loose with capital buffers. Which leaves us with this final, provocative thought. The next time you read a banking earnings report and see a massive dividend announcement, I want you to look a little closer. Because as this explainer has shown, that payout isn't just a simple reflection of top-line success. Are you seeing true, unburdened financial strength? Or are you just looking at the tightly regulated remainder at the very bottom of the RBI's safety funnel? Understanding the difference is absolutely the key to truly understanding the banking sector. Thank you so much for joining me as we decoded these critical regulations today, and keep questioning what's beneath the numbers.